Hello and thanks for watching the video. I'm Frank Kopfinger, Head of Investor Relations and Strategy at LEG. With our half-year results, we provided the markets with a couple of highlights, which I'm going to address in this short video. First, we increased our guidance to an AFFO range of 190 to 210 million euros from previously 180 to 200 million euros. Secondly, within this guidance range, this also reflects an increased investment spend to 34 euro per square meter from previously 32 euro per square meter. Thirdly, we reported an impact from devaluation of minus 1.6% and expect the valuation to bottom out from here. Fourthly, we made further progress on our disposals. Year to date, we sold roughly 2,900 units for about 285 million euros. And fifthly, our financing structure remains very robust. On a pro forma basis, our LTV is 48.3%, and we continue to benefit from an attractive financing structure. Let me walk you now through those highlights. Key highlight is certainly the increase of our guidance to a range of 190 to 210 million euro. This comes on the back of ongoing strong operational figures. We could further reduce the vacancy to 2.5% on a like basis. This is a reduction of 10 basis points. And we are on track for our rent growth guidance of 3.2 to 3.4% on a portfolio basis. Keep in mind that we have no cost rent adjustment this year for the subsidized part of our portfolio, which represents about 90% of the entire portfolio. So our rent growth guidance of 3.2 to 3.4% translates therefore into 3.8 to 4.0% for the free finance part. The guidance increase also comes on the back of a better interest expense result. On one hand, we benefit from our cash position as well as incoming cash from our disposals, which allow us to redeem some debt, but which also allow us to generate interest income. On the other hand, refinancing costs develop positively. And all this turns into an AFFO increase on our guidance of 5% if I take the midpoint. And it turns into even 10% growth on AFFO per share basis if we take the midpoint of the new guidance range against the previous year result. Then secondly, on the increase in investments. We have also raised our full year investment guidance by 2 euro per 34 euro per square meter, i.e. we want to invest more. And there are two reasons for this. Firstly, there will be investments into a commercial asset which was supposed to be sold. This commercial asset comprises a hotel and several commercial units. Unfortunately, the sale failed as the financing on the buyer side did break down. We therefore decided on a substantial investment to retrofit the property and to allow for a reletting of the hotel already next year. This commercial complex remains, however, non-core and is up for sale once our investments are done and rents have been adjusted. Secondly, we have increased the refurbishment investments to allow for further vacancy reduction. This is what you saw already in H1, and this is what is going to happen already going forward. And with this, we allow for a maximization of the pricing per unit, and this should support further rent growth. Then let me touch on the valuation. The devaluation cycle seems to really come to an end. As expected, devaluations have moderated down to just 1.6%. This is well within our guidance range of 1 to 3%. From the peak in H1 2022 to H1 2024, we brought down now valuations in total by almost 17% for the entire portfolio. The value per square meter for our total portfolio amounts now to roughly 1,600 euro. The gross yield of our total portfolio amounts now to nearly 5%, and the net initial yield stands at 4.0%. With this, we feel quite comfortable with regards to the yield being offered by our portfolio, and we see value stabilizing from here. Let me now come to our fourth highlight, the progress we made on disposals so far. We continue to make progress here. Year to date, we sold more than 285 million euros or 2,900 units respectively. However, until end of June, only 51 million euros have been transferred and are reflected within our H1 figures. This means that the remaining 234 million euros are going to be transferred until the end of the year, and we receive the cash accordingly. All our disposals have been done at or even slightly above book value, as we are not willing to pass on shareholder value to the buyers. On a net proceed basis, i.e. after redemption of the underlying debt, paying taxes and transaction fees, the 285 million gross proceeds will translate into net proceeds of roughly 193 million euros. This will be the cash which ultimately will bring down our LTV, and on a pro forma basis, i.e. taking all disposals so far into account, the LTV stands at 48.3%. Our medium LTV target of 45% remains unchanged. We continue to market further units on the transaction market, and we have currently around 3,000 units on the market and are confident that we will have additional disposals until year end. As said, those disposals help us to also manage our debt, which I would dive into now. So on the financing, our financing remains rock solid. We continue to benefit of an attractive financing structure. We have an average interest rate on our debt of still only 1.66% at an average maturity of 6 years. This means that higher refinancing costs will continue to only slowly affect overall financing costs. We have no 2024 debt maturities on the agenda. We paid down just slightly above 100 million of our 2025 maturities. And the majority of the remaining 2025 maturities of 858 million euros is covered by either excess cash or by the incoming cash from the disposals, which I was just talking about. So there are no remaining maturities until September 2025, when the convertible bond is due. This puts us in a very comfortable position to opportunistically refinance or repay some of the 2025 debt. Also, when it comes to debt KPIs, our ICR ratio stands strong in sector context at 4.3 times. And with this, I come to the end of my video. I hope it gave you a good overview on our first half 2024 results. You certainly find the entire reporting set on our webpage within the IR section. Should you have any questions, then please do not hesitate and give me or the team a call. Thank you and goodbye.
Disclaimer. As described in the legal section on our website, seat11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.